Okay, so welcome back. We're going to be learning the second depreciation called double declining. Now, we already took a look at the first one, which is called units of production, where it's based on a total amount of numbers of units produced. It's based on a capacity amount. It's not time sensitive or anything at all. But double declining is going to be a different one, and it's actually going to be more commonly used versus over units of production. But in this case, let's go ahead and dive right in to see the difference between the two. So again, we talked about the 5 components that you need to have in order to even do depreciation. We're going to be given the cost of the asset. We're also going to be given the estimated useful life, as well as a salvage value or a residual value. The one factor that we need to make sure is that the date that we placed it in service is very important. And then lastly, the depreciation method. So again, here are the 3 different types of depreciations that we will be looking today. We already took an activity-based method, all right? We got to take a look at how units of production, how we depreciate an asset based on how much units it can produce. It's not time sensitive. It doesn't matter how long the life is, as long as it reaches its threshold or reaches its capacity. So now that we've dealt with the first one, we're going to go ahead and skip over straight line, and we'll look at that after the break maybe. So we'll take a look at straight line afterwards. But we're going to be focusing on accelerated, or also known as double declining method. Now, again, all of these different interchanging words are going to be useful because I don't know what kind of setting you're going to be going into after you move on forth when you get your employment. Are you going to go into private accounting, doing at the smaller scaled bookkeeping? But are you gonna go to a grander scale, such as corporate? Okay, if you go into that, you're gonna need to know the difference between all the different names as well as what they could be interchangeable for. So the first one we took a look at was activity based or units of production. So today we're going to be looking at accelerated, or also known as double declining. Okay, so let's go ahead and take a look at double declining. So just as it says in its title, double declining essentially means that what happens is that when we are depreciating an asset, a fixed asset, we are going to depreciate it twice as much, all right? And when we understand what do you mean by twice as much? So most common, oftentimes, electronics, okay, example. Often when you buy the latest and greatest things, you tend to use them more frequently in the very beginning years of its life. But as as the years go on by, something else greater or better comes out, and you tend to, use the older product and buy the newer one, and you use that a lot more often. All right, so this concept is very, 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 very important because it's true. A lot of technology these days, they make it really good for the first couple years, and then it becomes slow, and then a newer machinery comes in to the market, and people would rather buy it and use that one a lot more first. Okay, this is a great example is for any of you who have students or college students, or even kids in general, or even if you guys are going to college or anything like that, school or something like that. You buy a brand new laptop. You use it so much in the very beginning of your school career, and then as you graduate, you use it less. Okay? Same thing with a cell phone. We have the latest and greatest iPhone 11. You're using it so much in the very beginning of its years, and then all of a sudden the new iPhone comes out. You end up buying the new iPhone, and then the iPhone 11, you don't use it as much anymore because you have a greater and better product. Okay? So this is why we need to consider the fact that because we are using it so much more in the beginning of its life, we're going to consider that it's going to be we're going to depreciate it faster than expected. Okay, so here's a few things that you need to know when it comes with dealing with time. Because you are depreciating it twice as much, it is time sensitive, but it is also not time sensitive, right? Your item, if it has a life of 5 years, but because you're using the item so much, you can only expect that it may not even last you 5 years. Most laptops, they say it's good for 3 years, and sometimes they go bad in the first year because of how often you use it. Okay? So with that being said, we'll go ahead and take a look at how time affects your asset, but also let's go ahead and take a look at the formulas. So of course we have the same constant five things that we're looking for. The first one is going to be the depreciation basis. This time, instead of making it the asset cost minus salvage value, it's going to be beginning of the year book value. Meaning that no matter where we start, every time we start our depreciation basis is going to be based off of the book value. Okay? Now, but this one's even more particular. It's the beginning of the year's book value. So that means this number is going to be constantly changing. All right? So the next one is going to be the depreciation rate. This rate is actually going to be different. It's not going to be like the per unit rate. This depreciation rate is going to be based off of 1 divided by the number of useful life. Okay? Usually it's determined in years. So that means we're not focusing on how much it produces. We're looking at how old the asset can be, or what its life is, expected useful life. All right? And then we're going to multiply it by 2 because it's double declining. You're going to depreciate it twice as much. Okay? And then your depreciation expense is going to be your depreciation basis times the depreciation rate. So because we have the depreciation basis changing every single year, and then you multiply it by the rate, you can expect that you're going to be cutting the value of it in half, almost half every single time. Okay? Or twice as much every single time. Okay? And then accumulated depreciation. Accumulated depreciation and your book value, these two formulas are always going to stay constant. They'll never change throughout any single method that we learned today. They're going to stay constant. So again, accumulated depreciation is going to be your previous year's accumulated depreciation plus your current year's depreciation expense. And then of course your book value is going to be the cost of the asset minus the accumulated depreciation. Okay? And then at the end of its life, book value must be equal to salvage value. And because we with the little concept that you need to know that the asset's life, or the asset's productivity level, it can end earlier than life's expectancy. Okay? If an asset can last you 7 years, it may only last you 5 out of those 7 years because you are depreciating it twice as much. You're I want to say damage, but you're damaging twice as much. So if you're going to be breaking it down faster and quicker, then you can only expect that its life will not last what it's meant to last for. Okay, and that holds true for anything, right? If you're using something that's so much, you can only assume that wear and tear comes naturally a lot quicker, all right, versus someone who doesn't use and abuse their products or whatever that they buy, the asset. You can expect that theirs is going to be in good condition because they barely use it. So let's go ahead and dive right into the example and explain each equation. Okay. So here we have an example. We're going to go ahead and record the depreciation for the first year. Here we have a machine. Okay, its asset is the cost of the asset is going to be $15,000. Salvage value is $2,500, and the useful life is 5 years. Okay, and the number of units that it could produce is 10,000, and the date that you placed it into service is January 1st. All right, this is assuming that when you do your depreciation, it's at the end of the year, so December 31st. So in this case, here we have a few, piece of information that is pertinent to us, but as also not really it's not really relevant. So first off, we have a machine, all right, and if it cost me $15,000 and the salvage value is $2,500, okay. Now the first thing that we're going to do is we're going to solve for the depreciation basis. How are we going to determine the book value of the asset? What is the book value of the asset right now?
15,000.
It's going to be exactly what you purchased the asset for. Fair market value, book value, meaning because we haven't even started depreciating it at all, it should still reflect that it holds the value of 15,000. So yes, 15,000 is your depreciation basis, okay? So let's go ahead and determine the rate. Your rate here is going to be 1, so the number 1, divided by the number of useful life times 2. Okay, so what's my useful life? 5. Okay, so 1 divided by 5 times 2.
0.40%.
Yes. Yes, it's 40%. Okay? It's 40%. Now, because we know that rule where most assets are either going to be 5, 7, 9, or 11, right? If you can remember that 1/5 or 5 years, you can automatically assume that it's always going to be 40%. Okay? So now that we determined that it's 40%, let's go ahead and solve for the depreciation expense. So depreciation expense is going to be the depreciation basis times the rate. So what is 15,000 times 40%?
6,000.
6,000. All right? And of course, what is my accumulated depreciation?
$6,000.
It's also 6,000 because we have no previous years and the current year is 6,000. So what is my book value now?
9,000.
It is 9,000. And notice this. we have a new book value. And what does the depreciation basis, what is it equal to? How do you solve for the depreciation basis? What is the depreciation basis?
15,000.
Not 15,000. Is it because now we're in year 2?
It'll be the 9,000, right? It'll be
Exactly. Exactly. That's exactly correct. Okay. So yes, now that we have our brand new book value, right? So the book value right now, as of year 1, it is 15,000. At the end of year 1, it is now valued at 9,000. So what does that make my year 2 book value be? It would make it my 9,000 because but depreciation basis is always going to be the beginning of the year's book value. So at the end of year 1, if my book value is now 9,000, then that makes my beginning for year number 2 to be 9,000. So that's what we have to recognize here, is that because book value, right, is going to be the second one, we're going to take the 9,000 and it's going to now become the depreciation basis. And now we can go ahead and calculate the second one. All right? So the second one is going to be the depreciation rate. Okay? So that's the second one. So same thing goes here. Now, but this time again, we have a new depreciation basis. So we take this, right? And then you're going to multiply it by that 1/5 times 2, which gives you your 40%. So what is 40% of 9,000, right? It's another 3,600. And notice this. Now that's another 3,600. We add those two together to now give us a new book value at the end of year 2 to be 5,400. Okay? So as you can see, it's a chain reaction, or they're just linking each other up until you finally come to the conclusion where your book value becomes equal to salvage value. Okay? So remember that rule. Book value can never fall below salvage value. Okay? So here's year 3. So I already did the calculation for you. And yeah. So there you go. That's year 3 for you. Now notice this. Notice this. Notice that the book value is shrinking drastically and it's only on its 3rd year. Okay? We also need to be aware of this. Because the book value cannot fall below salvage value, what is my salvage value right now? Do you guys remember?
2,500.
2,500. So right now we're at 3240. We're getting very, very close to the salvage value. So then what happens when I did year 4? What happened in year 4?
It fell below salvage value.
It fell below salvage value. And because it fell below salvage value, you cannot proceed with this. You must cross that out, because salvage book value can never fall below salvage value. So therefore, what you're going to do is you're going to actually replace the book value with the salvage value. And when you do that, then you're going to have to work backwards to solve for what the depreciation expense is supposed to be. okay? Even though you have your book value or your depreciation basis at 3240 and you have your 40%, you must resolve so then everything else makes it evened out. Okay, so this is where we're going to have to use a little backwards math. So as we saw here, right, it fell below by 1044. We need to now find the methodology to be able to switch out that number, place it as 2,500, and find the methodology to get this number to equal 2,500. Okay, so that means we got to work backwards. We got to work backwards to the point where we have to recalculate our accumulated depreciation. All right? And then the accumulated depreciation is going to be equal to your total, your asset cost minus your salvage value. Okay? And then working backwards from there, you also have to find out what the depreciation expense is, which is going to be your accumulated depreciation minus your previous year's depreciation. Okay? And that's how I got 740. All right. So we have to work backwards here, and then I'm gonna when we go dive into the example, it will make more sense with the example. So as you can see, less than 5 years. Okay. Second thing is the depreciation basis is always going to be changing. It's always going to reflect the beginning of the year's book value, which is going to be taken from the last column, because the last column is our book value column. Same thing here, the rate stays the same, but notice this, it is times by 2. And then of course, our last year of its life, it must reflect the book value. Okay? Book value can never fall below salvage value. Okay? Any questions about this? Okay. So, journalizing is by far going to be one of the easier concepts to understand. It's only calculating is what's going to, cause us to make the most mistakes. Okay. So again, here, let's go ahead and journalize the depreciation for the first year. I brought the table down here. So what is going to be my journal here?
Depreciation expense
Yes. And what else?
and accumulated is depreciation.
Good. And for what amount?
6,000.
Okay. Good. All right. So again, journalizing is going to be the most easiest part. It's just calculating is what's going to be the most confusing part. All right. And of course, second year, this is what it looks like for the second year. Okay. Same thing, but it's 36,000. Just make sure that you know that every year the journal will look different. Okay. So then, now this is where I'm going to talk to you about what partial years is and how we are going to, how it affects calculations. Okay. So we said that with this kind of idea, we know that this is going to be this. We know that when we're using double declining, because we are depreciating the asset twice as much, right? Notice that my 5-year asset only lasted for 4 years. Same thing that's going to go here. This is also time sensitive because, again, when we place the asset into service, we need to consider how old the asset really is. So in that case, my asset could be only 3.5 years old, right? And it depreciated down to its salvage value. Okay. So in this case, for this example here, we have a machine that's worth $10,000 with a salvage value of $2,500, and we know it's supposed to last us 5 years. Okay. And I have the number of units produced is 25,000, which we don't care about. And the date that we place it into service is October 14th. So, because I'm starting in October 14, how many months am I actually going to depreciate it for the first year, assuming that the year is from January to December?
2.
3.
3.
Yes, because why is that? Someone explain to me why it's 3.
October
Because it's
December.
October 14 is not after 15.
Correct.
Okay.
Correct, because when we place it into service, we also have to consider that whole date scenario, right? If it falls anywhere between the 1st to the 15th, you need to depreciate it that year because that is more than 50% of the month, okay? If it falls after the 16th, from the 16th all the way to the 30th/31st, then that is less than half of the month. So therefore, you can go ahead and safely assume that you can go ahead and depreciate it the following month. Start the following month. So in this case, I did it on October 14th. October 14th, so that's actually more than 50% of the month. So that means I have to depreciate October, November, and December. And how many months is that?
3.
3.
It's 3, correct. So now that means my first year's depreciation, I'm only depreciating 3 months out of 12. Okay, so make sure you remember that number because this is where it's going to come into play. So let's go ahead and solve my depreciation basis. Okay, so my depreciation basis is going to be my beginning of the year book value. In this case, how much is it?
10,000.
It is 10,000. Good. And what's my depreciation rate? Okay, it's going to be 1 over the estimated useful life times 2. So what's my depreciation rate?
40%.
It is going to be 40%. Therefore, what should be my depreciation expense?
4,000.
Okay. Now, when we look at this, right, this is assuming that this $4,000 is for the whole year. But how old is my asset?
3 months.
It's only 3 months. So therefore, we need to do an extra calculation here because it's only 3 months old. So this is where we have to apply our knowledge and say, well, what is 3 months out of 12, right? And how much of that is can I multiply that by 4,000? How much is that going to be? That's going to be my depreciation expense. So knowing that my asset is only 4 years old, then I can go ahead and calculate 3 months out of the 12 to go ahead and solve for it. So 3 out of 12 is 1/4, or also known as 25%. So what is 20 5% of 4,000.
0.25.
No, 25% of 4,000.
1,000.
1,000. And it's right here. So that's going to be my depreciation for that year, because I have to assume that my asset's only 3 months old. I cannot depreciate it for a whole year, because that's one waste. That's a waste of it. That's a waste of my asset. Plus, I have to consider that when I start my asset, it's based. It's like a kid, right? You count it on the day that they were born. So in this case, we're counting it on the day that we placed it into service. All right? Does this make any sense? Is this clear?
Yes, for me.
Okay.
Yep. Yeah, that
Okay.
makes sense.
All right. So, and that's exactly why we're looking at the estimated useful life, because we have to understand that what we're essentially doing is we're trying to take the asset and we're trying to expand it, or evenly distribute it across its life. But because we're using it so much in the beginning of its useful life, we need to multiply that by 2. So therefore, it's going to allow me to shorten the asset's life, because I am, using it so much in the beginning of its years. So that's where you're going to have to make sure that it's time sensitive here, because it's very important that you understand that my asset's not 1 year old. It's only 3 months old. Okay. Right. And then, of course, now journalizing it is going to be standard, right? Because now that I've solved that my asset is now $1,000, right? Or the depreciation expense is only $1,000. So therefore, how am I going to journalize it?
Depreciation expense.
Mm-hmm. Mm-hmm.
Depreciation.
Mm-hmm. For $1,000.
1,000.
Okay. All right, and that is chapter 2 review for you. 11.2. That is the 11.2. Here's the review. Here's the formula for you. And here's a little concept for you as well. When your book value is less than salvage value, this is what you got to do. These formula right here is basically taking the formula that you already know, but working it backwards, because in this case we're using math to solve the equation, right? If 1 plus 1 equals 2, right? And I give you 2 and I give you 1, what is the variable that you're looking for? So what plus 1 equals 2? That's essentially what I'm doing here. Okay? So we're going to be so once your threshold, or your in this case, once your book value falls below salvage value, you're going to have to work the formula backwards. Okay? And of course, again, the definition of it is when you choose to use to the asset be more in the beginning of its life than later on. Okay? So let's go ahead and dive right into the exercise right here. So 11.2 exercises. So in this example here, okay, you purchased a computer for, let me make sure I'm on question number 1. I gotta go question number 1. There you go. Question number 1. All right. You purchased a cash register for $300, okay, with no salvage value. Okay. Its useful life is 5 years, and it can print up to 5,000 receipts. Okay. And you put this cash register in service on January 8th. All right. So assuming that the depreciation is done at the end of the year, December 31st. So let's go ahead and fill in my blanks right here. So what is my asset?
Cash register.
Good. What is the asset cost?
300.
Okay, $300. What's my salvage value?
0.
It is 0. Okay. And what's my estimated useful life?
5 years.
It is 5 years. And then when did I place it into service?
January 8th.
So that means, am I depreciating as of January or am I depreciating as of February?
As of January.
As of January, because it fell on the 8th. Okay, that's before the 15th, so that's definitely more than 50% of the month. All right, so let's go ahead and solve for our depreciation basis. So what is my book value?
300.
Yes, right? The day that we bought the asset's going to reflect how much it costs right now. Okay? And let's go ahead and solve for my depreciation rate. What is my depreciation rate?
Be 40%.
It'd be 40%, yes. Or in this case, 0.4 to make math a lot easier, okay? So now that I have these information, then what is going to be my depreciation expense for year 1?
120.
120, making my accumulated depreciation to be
120.
20.
120. And then lastly, so what is going to be my new book value?
180.
It's going to be 180. Okay. So therefore, what is going to be my book value, beginning of the year book value for year 2?
180.
It's going to be 180 because we solved it here. So that's the end of the year for year 1. That makes it the beginning of year 2. All right. And then since we know that this rate here, 40%, is going to stay constant, so I can safely assume that for all the years, it's going to be 40%. Okay? So therefore, what is going to be my depreciation expense for year 2?
72.
72. And what is now going to be my accumulated depreciation?
192.
192. So therefore, what is now my new book value?
$108.
108. Okay. So therefore, that makes it my beginning of the year for year 3. So same thing here. Now we got to keep calculating. What is 40% of 108?
43.
4320.
4320. So therefore, what does that make my accumulated depreciation here?
235.20.
235.20, making my new book value to be
6480.
6480, and that makes it for my book value for year number 4 here. Okay, and then what is 40% of 6480?
2592.
2592, making my accumulated depreciation to be
26112.
26112, bringing my book value to be
3888.
3888. So now I'm reaching my last year with 3888. What's 40% of 3888?
15.552.
Okay, good. Bringing my accumulated depreciation to be
276.67.
276.67. Bringing my book value to be
23.33.
2333. All right, so that means we could keep going. But here's a concept and rule here. My machine is already at the end of its life. If I continue to keep having it around and continue producing my products, right? I have to assume the risk that if I keep pushing the product to go over its useful life, I have a potential that the products could be defected. And that's going to also be considered a waste of material to produce if I'm have a possibility of, creating damaged goods. So in this case, my salvage value has never been met, but that's okay. My book value never fell below salvage value. And in this case, my salvage value is 0 anyways. And we talked about this too. Can your book value ever fall below 0? Absolutely not. You can't tell me, hey, my printer is 5 years old and it's worth negative $100. No, no, no one's gonna buy it. No one's gonna, at that point, it's scrap metal. Okay, so same thing here. Now that we reached the point where my salvage value is now has not been met, right? My book value is above salvage value. This is safe to assume that we can safely dispose this asset. Okay, just because it's reached its last years of its life, and again, it would cost you more money to produce damaged items, defective items, than it is to just go ahead and just invest into a new machine that can produce, like perfect items in this case. Okay, so in this case, if you want to learn how to properly dispose a fixed asset or anything like that, just go ahead and read chapter 11, and there's a small section on disposing the asset. Okay, so now that we've reached the end of its life, let's go ahead and journalize it. So again, question number 2 says here, you're going to journalize for the depreciation for the first year, and then question number 3 is you're going to depreciate for the second year. So let's go ahead and journalize this as we assume that it's the end of the year. Okay, so what is my journal going to be?
Depreciation expense.
Mm-hmm.
Accumulated depreciation.
Good. So depreciation, expense, and accum for short for accumulated depreciation. Okay, and then for what value was it for the first year?
300.
300 for the depreciation expense.
120.
Oh, 120. Sorry.
120. Okay. Okay. And then what is my depreciation expense for the second year? So same journal here is going to apply. You got the depreciation and you have the accumulated depreciation. So what is my depreciation for the second year expense?
72.
$72 even. And that's pretty much all you have to do. So in this case, we're just aware that we are depreciating it. So let's go ahead and take a quick second to go ahead and take a look at how drastically my book value dropped. It literally went from 300 down to 180, down to 108, down to 64, down to 38. It's almost depreciating by 50%, or in this case, it is 40%. So as you notice that every year that you depreciate it, it loses its value almost by half, right? And notice this too. Every time we depreciate it, it starts off very a high value at the very beginning, and then it slowly decreases as it goes down the years. Okay. Good job. Let's go ahead and now go move on to question number 4. So here we are. Now we purchased a computer for $1,988, including all fees and a salvage value of $200. Okay, is that $200? Okay. Its useful life is 5 years, and you put this computer into service as of August 25th. Assume that the depreciation happens at the end of the year. So let's go ahead and figure out and fill out my top part here. What asset did I buy? What did I buy?
Computer.
I bought a computer. Okay. How much did the asset cost me?
1988.
$1,988. Did I have a salvage value to it?
Yes.
How much
200.
was it? 200. Okay. And what's my useful life?
5 years.
5 years. And then when did I place it into service?
825.
August 25th. Okay. So knowing that I placed it into service as of August 25th, when do I depreciate it?
September.
September. Okay. And because we're assuming that we're doing depreciation for the whole, at the end of the year, how many months am I going to depreciate this asset for?
4. 5.
4 or 5?
4.
4.
4. September, October, November, and December, because we're not including August. Okay, good. So now let's go ahead and get started. So what is my depreciation basis going to be?
1988.
1988. It's the beginning of the year book's value, which in this case, we're starting depreciation, so it's going to be 1988. What is going to be my rate this time? It's 40%. Okay. Now, because I'm using 1988, I'm going to safely assume that I have to use an equal round formula. So what is going to be 40% of 1988?
795.20.
795.20. Good. So what is my accumulated depreciation?
Well, it'd be 795.20 if it was for the whole year, right?
Good.
Only did 4 months.
Good. Good. So therefore, 795 is for the whole year. So how am I going to calculate this amount, including? First off, how old is my asset, and how much do I need to depreciate it for?
It's only 4
Only
months old.
4 months, so it'd be, yeah.
4 months out of 12. Good. So let's go ahead and calculate that. What is only 4 out of 12 months? What is 1/3 of this?
It's
0.33 and 262.4127.
Okay, so I'm going to go ahead 4 out of 12, and let's see. What did you say, Irina?
Mine is 262, but I going 0.333, so I have to cut. Did you round?
I did round.
Okay.
Okay, here, let me see. Let me do this real quick. Times 4 divided by 12. I still get 265.07. Anybody else calculate this? So what I did is I went ahead and this is how I do my calculation, right? I go ahead and take the 1988 and I multiply it by the 40%. And then I multiply it by 4 and dividing the entire thing by 12 because I'm only doing 4 months out of the 12. Okay? If you want to do it, you can calculate your 4 out of 12, which is 1/3, right? And you can multiply. Okay, hold on. Let's do this. Okay, so what is 4? Okay, hold on. I did that wrong. What is 795.20 divided by 3? 795.20 divided by 3. What do you get?
265.07.
265.07. Okay. So we're only calculating 1/3 of the year, right? 4 divided by 12 is 1/3, right? So if we understand that we only need to calculate for 1/3 of the year, then my value from 795.20 has now been cut in 3 to reflect 265 because my asset is only 4 months old. Okay? So therefore, now what is my accumulated depreciation?
265.07.
265.07, bringing my book value to be
1722.93.
22.93. Okay? So then that becomes my new book value. Okay? So again, same thing goes along here. It's going to be 40% all the way down. So what is now? Now, right? I've depreciated for December 31st. Okay? So therefore, when I move on and start depreciating it as of January, and this is a full year, we can now safely assume, and you don't need to do any other calculations here, because I'm depreciating it as of January all the way to December. Okay, so now let's go ahead and calculate this.
So would it be 689.17?
Let me see, 689.17.
That's what I got.
Yes, because in this case, the asset is still is still in service, right? We've already depreciated the first year, right? We knew that we placed into service as of August 25th. That means when we start the second year, we are depreciating it for the whole year. We're starting to depreciate from January all the way to December 31st. Okay, so therefore, because the asset, right, its life is 5 years, so in this case, we're now depreciating it for the whole year. So in this case, yes, 689.17 is correct. So let's go ahead and add these numbers together. And what do we get for our accumulated depreciation?
954.24.
954.24, bringing my new book value to be.
768.69. Oh no.
I did not get that.
1033.76. Yeah. That's
Yep.
not bad.
Did you say 7?
Yeah, my bad.
Oh, no. Is it? Did you say 7? Is it 7?
No, I get 76.
77. You started with 3 cents. Let's see, 77. I got 76 because if I started with 1988, that's 0 minus 4. 4 should give you 6. So you could have a rounding error right here.
I got 1033.76 also.
Yeah, I
Oh.
get 76.
Okay. Just making sure we're all on the same page here. So good. So now, book value or beginning of the year book value for year 3 is going to be the 1033.76. So now, what is 40% of that?
413.50.
Make sure you round up.
Yeah, 413.50 also.
Yeah,
You did?
yeah.
Yeah.
Because mine's come out 413.50.504.
32. Mine's 413.50320.
503? I don't know why mine's not Excel. Let me see. I still get 51. Let me expand it and see why it's that one. Cuz I got 505.3. Okay.
When I do it just on a calculator, it comes out to 413.504.
Yep.
Me too.
That's what
I got the same thing as well.
So that means
504.
it's an extra rounding, yeah.
Yeah, so in this case I am going I'm just going to type it in since we know that it's going to be what was it? 413.5. Yeah, I'm going to leave it like that. So it, you know, whether it's Excel or whether it's our calculators, we still get a rounding error no matter what. Okay. So now that we have the 5413.5, what is my accumulated depreciation here?
1367.74.
Okay. And then now what is my book value going to be?
620.26.
62026. All right. So then what is, now that brings down to my book value for year 4 or my depreciation basis. So what is 40% of the 620?
248.10.
248. Oh, why am I getting this penny off? 248.10. All right. Bringing my accumulated to be 1615.84. So then what is my new book value as of year 4?
372.16.
372.16. So let's take a look at this. What's my salvage value?
200.
200. So can we keep going?
Yes.
Yes, we can. So now let's go ahead and solve this part right here. So 372.16. Okay. What's 40% of 372.16?
148.86.
Okay. Bringing my accumulated depreciation to be
1764.70.
okay. And then my book value as of year 5 is going to be
223.30.
good 223.30. Now, can I go on for a 6th year?
Yes.
Why?
Because we are salvage values at 200. We have 223 book value.
Okay. Okay, that's okay, good. That's okay, a valid reason. What else? Why else? How old is my asset right now?
It's actually only 4 years old.
It's only 4 and 4 months old.
Yes.
So that means yes, you definitely can continue its life because it hasn't reached it hasn't reached its 5th year yet. And the second validation is that it's still got $23 left in its it still can produce more. So in this case, what is going to be 40% of this 200 and
89.32.
89.32? 89.32, bringing my accumulated depreciation to be
18.5402.
okay, 18.5402, bringing my book value to be
133.98.
good. Now, can my book value be 133.98?
No.
No.
No. So therefore, what does it have to reflect?
A $200 salvage value.
Yes, it needs to reflect as $200. So I'm going to put it right below so you know where these calculations are coming from. So I'm going to go ahead and cross this out. Oh, where is it? Here. Strike through. Oops, strike through. Okay, so there you go. I don't need that 133.98. It needs to be 200. So now I have to actually work backwards. Okay, so knowing this, that it needs to be 200, right? So then how do I solve for my accumulated depreciation? Okay, so what is the formula for accumulated depreciation? What is the formula for my accumulated depreciation?
Previous year accumulated depreciation plus current year's depreciation expense.
Good. Previous years plus current depreciation expense. Out of all of these, okay, actually, I have to work another one backwards now. Okay, in order to solve accumulated depreciation, we know, how do you solve for book value?
Cost of the asset minus accumulated depreciation.
Good. Book value is equal to cost of asset, okay, minus accumulated depreciation, right? So let's go ahead and solve that because we know what my book value is and we know what my cost is. So let's go ahead and solve it here. So what is my book value? Right now, what should it be?
It should be at 200.
200, good. And we know that the cost of the asset, how much is the cost of the asset? What's my cost of the asset?
It was 1988.
1988. Okay. And so my variable I need to solve here is, I'm going to call it A. All right. If I know this concept right here, that 1988 minus blank equals 200. So how do I solve for that A? How do I solve for that A? $19.88 minus something
200.
gives me
Minus the
200. Yes. So then what is A? What is my accumulated depreciation?
1788.
1788. Good. Now that I solved that this is 1788, I can go ahead and solve for my, excuse me for that. I can go ahead and solve for my depreciation expense because I have all the components now, right? I have 1788. So here, the formula is my accumulated depreciation is equal to 1788, which is equals to the previous year's plus the current year's depreciation expense. So how do I solve this? If it's going to be 1788, right? 1788 is my accumulated, and I know my previous year, right, is 1764 and 70 cents. How do I solve for my current year's depreciation? In this case, I'll put C. Okay? If 1788 is equal to 1764, oh, it's plus. My bad, not minus, plus. How much do I need to add to get to 1788?
2330.
2330. And that's how you solve backwards. You're going to take the formula that already exists and you're just going to plug in the numbers. So in this case, it was 2330, right? Other things that you can take a look at is, well, I mean, look at it. If my salvage value is 223.30, then that means I need to depreciate $23.30 in order to get to 200. So there's multiple ways that you can look at it in terms of how to solve for the depreciation expense for year 5. Okay, so there you go. Strike through. So you know, I don't know why that one's so small, but there you go. So striking through them. So that means for the 6th year or its remaining life, right? It's remaining 8 months. You're going to depreciate it for $23.30 so that you can meet your book value to equals your salvage value of 200, right? So now let's go ahead and journalize the rest of this. So question number 5 and question number 6 says to journalize for the first year and journalize for the second year. So assuming that we are at December 31st, what is my journal going to be?
Depreciation expense and accumulated depreciation.
Good. For what value? Okay. What was the first year's depreciation expense value? 265.07. So 265.07. Same thing down here. Okay. And then of course the journal is going to reflect the same for the second year. So then but this case we have a different value. So what is going to be my depreciation for the second year?
689.17.
689.17. Okay. And that's it. Good. Okay. So do we understand how to do the second part here, where or not the second part, what happens when our depreciation, I'm sorry, the book value falls below salvage value? Do we understand how to calculate backwards? You're essentially taking the same formula but plugging in what you know and solving for the X factor variable. So in this case, we worked backwards, right? We knew what book value should be. It should be 200. So therefore, the formula to solve for book value is your cost minus the accumulated depreciation, which we know the cost already. So in this case, it is 200 minus the 1988, which gives you 1788. All right? And then working your way back again, because we know what the accumulated depreciation is, we subtract the previous years to get the current depreciation expense for that year. So in this case, you can also take a look at it as well here. Oh, I only have $23.30 left to depreciate for the next year. So that could have also played here, and then you could have worked forward instead of worked backwards. Okay, there's many ways that you could figure it out. Also, some people also kind of figured it out by actually calculating the percentage based on this, like how many months it has left. So there's a lot of factors that you can do and can't do. So, or I mean, there's many ways that you can solve the same problem. All right, as long as you get the correct answer. All right. Any questions in regards to double declining?